My name's Austin Rutherford, and I own a $25 million real estate portfolio without using any of my own money, using the BRRRR strategy. With this strategy, you don't need to have a 20% down payment. You don't need to have certain debt to income ratios. You don't even need to have a tax return or verification of income. And the best part about this is you can literally get houses for free. You can own real estate to build wealth for yourself and your family without using a single penny of your own money. And if you do it the right way, you can even get paid to buy this real estate. You can build insane wealth for yourself and your family and get out of that rat race life that everybody's in using this strategy. So in this video, I'm gonna break down what the BRRRR method is: buy, renovate, rent, refinance, and repeat. And if you stick around to the end, I'm gonna give you 4 tips, 4 ways on how this strategy still works in today's market, irregardless to the high prices of homes, irregardless to the high interest rates that are out there, irregardless to what anybody says, this method still works. So the B stands for buy. So you go out there and you buy a piece of real estate at a discount using other people's money. So there's 2 ways to use other people's money. It's called hard money and it's called private money. Private money, you can get 100% funding for this deal without using a single penny of your own money. Hard money usually funds about 80 to 90% of the deal, and then you would just have to bring the difference to the table. But I'm telling you, I've done this all using private money lenders that fund 100% of these transactions. So after you buy it, then you need to renovate it. The second letter R is for renovate. So after you purchase this property, you then have to go in and renovate this property to get it back to today's standards. You're able to do this, again, using other people's money, private money lenders, to fund both the purchase and the rehab of this asset. Now, once it's renovated, the next letter stands for rent. So you have to go out and you got to find a tenant to rent this property. So the property is now in great condition. You just renovated it. And the best way to find a tenant is simply listing the house on Zillow. If you have a decent looking house, which it should be because it's renovated, in an okay area that has people that need to rent houses, which is everywhere, posting that on Zillow will be a great way to bring a tenant into this property. We never have issues renting properties. You know, that's one of the big concerns people have, is like, what happens if I can't find a tenant? People are looking for housing. You're supplying good housing, somebody will rent the property if you put it on Zillow.com. So the 4th letter stands for refinance. This is where it kind of gets a little bit tricky, and this is where I really want to hone in on this video on how this works. So after you buy, renovate, and rent the property, you have to go to a bank to refinance this property. Typically, banks will give you a 75 to 80% cash out refinance. So this means that if this property is now worth, let's say $200,000, the bank will give you back $150,000 to $160,000. So let's look at an example. Let's say you buy a house for $100,000. So you borrow money, 100 grand, to purchase this property. And then that house needs $40,000 of rehab to get it back to today's condition. So you borrow another $40,000 to fund that renovation. So you borrowed 140 grand to fund this deal. Now, they're not giving you this money for free, so you're gonna have to pay interest on it. So let's say 90 days later, you get it renovated, rented, and you're in the refinance process. So you'll owe another roughly $6,000 in interest to your lender for lending you the money. You'll also have to pay a roughly $1,000 appraisal cost and another few $1,000s in closing costs to be able to actually close on the refinance transaction. So you owe $140,000 plus another $10,000 in additional fees and interest payments. So you're into this deal for $150,000. So if this bank gives you a 75% cash out refinance, 75% of 200 grand is $150,000. So you take that $150,000 and you use that money to pay off your private money lenders and all your expenses. So now you own this house 100% yourself with a bank financing in place that allows you to cash flow positively and make money every single month on this property. Let's look at it one scenario better than that. Let's say you find a bank that'll give you an 80% cash out instead of a 75% cash out. 80% of $200,000 is $160,000. So the banks give you $160,000. You owe $150,000, remember? So you take that $160,000, you pay off the $150,000, and the additional $10,000 that you get to keep, and you don't have to pay taxes on it because refinance proceeds are non-taxable. So you can actually get paid to buy real estate. It's crazy. So if you made it this far, if you could smash that like button, it really helps my channel out. I would greatly appreciate that. But let's really get into it. Here's the fun stuff. The 4 tips that make this BRRRR process still work in today's market. Tip number one is, who do you go to refinance these assets? One is a small local community bank. These are not your Chase, your Wells Fargo, your Bank of America. It's not those people. These are small local community banks. So this is like Richwood Bank, Bexley Bank, Citizens National Bank of Bluffton. These are local banks in a specific market. Usually they're kind of like in the country of wherever you're at. These banks will typically give you the best terms when you go to refinance these properties. They'll give you a 20-year loan, a 25-year loan, sometimes a 30-year loan, but usually it's 20 to 25 years. And the thing with this is every bank has different guidelines. So this bank one might be a 20-year term at 7% interest. The next bank you talk to might be a 25-year term at 6% interest. The next bank you talk to might be a 25-year term at 9% interest. So you have to talk to enough of these banks to get the terms that you want. So what do you want? You want a high cash out refinance, so you want 75 or 80% on the cash out. You want a low interest rate, the lower the better, and you want a longer amortization schedule. So if you can get a 25-year instead of a 20-year, that's good. If you can get a 30-year instead of a 25-year, that's good. It means that your payment will be lower, which will allow you to cash flow and make more profits. So tip number one is find the right small local community bank. Tip number two is, if you can't find a small local community bank that has the terms that you want, you can use a loan called a DSCR loan, a debt service coverage ratio loan. The beautiful thing about this is that you don't need to even show any tax returns. You don't need to have 2 years tax returns. You don't need to provide bank statements or financial statements. You don't need to do any of those things. This loan is based on the asset. So as long as the asset brings in more money than your expenses, it works, which a lot of properties work for this. So the other good thing with this scenario is that these loans are 30-year amortizations. So with small local community banks, if you can only get 20 or 25 years and the deal doesn't cash flow, then you can use a DSCR lender to get a 30-year amortization. So then your deal will actually cash flow positive, so you can complete the refinance on the property. Tip number three, a lot of people talk about the DTI. It's one of the biggest questions I get, is your debt to income ratio. Because typically with conventional loans, you have to make a certain amount of money to be able to get a certain amount of debt. In this scenario, it doesn't even matter. DTI is out the window. Why is that? It's because you're buying a cash flowing property, an income producing property. So technically, if you buy these deals correctly and they cash flow positively, you actually become more bankable the more deals that you buy, because your income continuously is greater than your expenses. So your debt to income ratio actually gets better. So I don't really pay attention to DTI at all. What I pay attention to is DSCR, debt service coverage ratio. What this means is that you have more money coming in than you have going out. So if your total expenses on a property are $1,000 a month and you bring in $1,500 a month, you have a 1.5 DSCR or greater. Most people look to have a minimum 1.2 or greater. So that's the only thing that I look at. I want all my properties to be at least a 1.2 or greater on a DSCR, on a debt service coverage ratio. Now this is the fourth tip, and this is what nobody is talking about. So let me break this down to you. If a property cash flows on the scenarios that I just gave you, on a small local community bank or a DSCR loan, I'm doing that. Let's say though, when you run the numbers, your cash flow is a little bit tight. Let's say your expenses are $1,000 a month and your income's only $1,100 a month. You want to make more money so you have a bigger cushion on cash flow. This is where this strategy comes into play. This is called an interest-only loan. So what this means is for 10 years, I have a fixed interest rate where I'm paying interest only. So I'm not paying down my principal like I would with a small local community bank or a DSCR lender. I'm just paying the interest payments. Now, why do I do this? It's because it allows me to increase my cash flow. So instead of my expenses being $1,000 a month, it might be $800 a month. So it turns an asset that did not work, was not cash flow positive, into a cash flow positive asset. So I have 10 years of interest only payments. So my strategy with this is to use an interest only loan, and then sometime over the next 10 years to then refinance this property again once the interest rates come down. So this is not something I'm doing forever. I'm not planning on holding interest only for the next 50 years. I'm planning on holding it sometime between 2 and 10 years. and then refinance when the rates come down. And the reason I'm doing this, to put it into perspective, let's say I'm getting a $150,000 loan and the interest rate is 7.5% interest. If I went down and got an amortizing loan from a small local community bank at, let's say, 25 years versus a interest-only loan, my payment is $171 less with the interest-only loan, meaning that over a year span, I make $2,050 more in positive net cash flow. So the only reason people go bankrupt or go into foreclosure is from lack of cash flow, is from having more expenses than they do income. In this scenario, this is a strategy to decrease your expenses to then increase your profit. So if you have significantly more profit, guess what? Lower chance of filing bankruptcy, lower chance of going into foreclosure. So this can be an extra tool that's in your tool belt to be able to acquire and purchase more real estate, which then allows you to build wealth through the ownership of real estate using other people's money for you and your family. That's why I love this strategy, because as prices get higher, interest rates get higher, competition continues to go up. This little extra strategy, the interest-only loans, allows me to purchase more real estate. It's truly a beautiful thing. The BRRRR method is an absolute game changer. I've been able to use this strategy over 100 times, which now pays me tens of thousands of dollars a month in profit and has allowed me to become a multi-millionaire, all using other people's money. Now, I know we talked about, hey, buying real estate with other people's money. These people are called private money lenders. Your next question may be, hey, Austin, that sounds great, but how do I find these other people to fund my deals? Make sure you watch this next video here where I tell you just how to do that.